Let me introduce our panel. First is Alex Pollock. Alex and I know each other from many incarnations, and we are both former philosophy majors, so we communicate at that level also. But Alex is now the senior fellow at Mises Institute. He's also the author of Finance and Philosophy, which fits into my discussion here. And the latest book, Surprised Again, The COVID Crisis and the New Market Bubble. Alex worked in the Treasury at what was the name of that agency? Forgot it already, Alex.
The Office of Financial Research.
The Office of Financial Research, right. All right, and to my right is Professor Paolo Saguato. Paolo and I worked together when we were when I was at Scalia Law School. Paolo's a prolific writer and a terrific guy, and spends enough time in Italy to make me jealous every year. Right, exactly, that's what I was going to say. And lastly is an old friend, Rich Wald, who I knew when he was 12 years old. He's now 18. Vice Chairman of Emigrant Bank. And what we're going to talk about here is reimagining financial stability, deposit insurance, and central banking. Sort of a potluck on the issues that are outstanding today. And let me start with you, Alex. You and I have talked about a lot of issues over the years, and I know one that's sort of on your mind and on my mind is the Genius Act. I sort of argue that we've done things backwards here. We should have regulated cryptocurrency first and then stablecoins, but now we've decided that we can regulate stablecoins first to deal with the cryptocurrency issue. But put that aside. How do you think the Genius Act entangles the stablecoin risk and the banking system risk? And what are the regulatory implications? Are we infecting the financial system with something that we ought to be thinking a little more about in terms of financial stability?
Thanks, Tom. And yes, I think we are. I think the entanglement of stable coins and the banks is the right term. Of course, in most of the popular discussion of the Genius Act, when it was enacted, and most of the press all talked about how stable coins would be backed by treasury bills, and every way to have these treasury bills, and the stable coin issuers would buy treasury bills. But that isn't the only thing, of course, that the Genius Act says. It says these stable coins can also be invested in deposits, in insured depositories, and in their foreign correspondents. Now, those deposits would be uninsured, at least in large measure, and unsecured. And whatever you may think about banking risk, and we know, Tom, you wrote a whole wonderful book about the number of times that banks and the banking systems have collapsed historically. Whatever you may think about it, we know that banking risk is an utterly different risk than treasury bill risk. And so to the extent that the stable coins can be invested in bank deposits, that is an entanglement with a completely different sort of risk than owning treasury bills and being a sort of government money market fund. You mentioned the history, Tom. Of course, under the National Banking Act, the notes of the national banks all had to be secured by government debt. And the controller of the currency's job was to hold on to the collateral for the bills. So there's a repetition there of the idea. But if you think of what assets deposits in banks represent, well, they represent anything a bank can do: commercial real estate, loans to emerging market sovereigns, private equity financing, private credit, and subprime mortgage-backed securities, whatever a bank can do. So the assets underlying the stable coins that are invested in deposits are a completely different kind of risk, and the upcoming regulation needs to address that. And I know people have thought about it, and they need to think about it and put in the right rules. So it's obvious that this risk exists because we already saw it with Silicon Valley Bank and Circle's stablecoin, which was over-invested in Silicon Valley Bank. And when the bank went down, it would have imposed giant losses had you had a market outcome. Instead, we had a bailout and the regulators declaring a national systemic risk emergency in order to bail out unsecured depositors, including the stablecoin issuer. And that can obviously happen again, and you don't necessarily escape it only by putting your deposits in the biggest banks, because the biggest banks can also get in trouble, and that there are lots of examples of that in banking history. And I just mentioned this issue of the foreign banks is also very important to think about how much of the stablecoin banking should be in foreign banks. Practically anybody can be a correspondent at some insured depository. That's certainly a heavier risk. And finally, there is the problem of having your own bank. If you're a bank with a stablecoin subsidiary, as set up by the Act, you can issue the stablecoins and, at least in theory, just put all the money into your own bank as a deposit, and then it is just a bank deposit. Moreover, if you're a stablecoin issuer, you could set up your own bank to own your stablecoin issuer, so you could do the same thing, and all of the stablecoin proceeds could go into your own bank. This is not what people picture when they're thinking about a treasury bill money market fund, to say the least. Regulatory implications, I think I just will mention quickly. I think the FDIC is right that stablecoin funds should not, and it would be against the idea of the Congress and the Genius Act to allow pass-through coverage. Clearly, regulators have to think about diversification and concentration of banking risk. They have to think about the capital required, for example, to hold deposits in banks in, say, the British Virgin Islands. They have to think about financial statements. I think anybody who puts money in the hands of the public should be reporting full financial statements at least quarterly, something like a call report maybe. And finally, the Financial Stability Oversight Council, FSOC, should take up the systemic question. If we have a stablecoin system entangled in banking risk, which means if the banks get in trouble, then the stablecoins are in trouble. And if the deposits are being withdrawn, the stablecoin managers will be among the first to be getting their money out. So you'll accelerate the problem in the banking system and intensify the banking crisis. So you really are creating a mixed system of both, and challenging and very important to work on, I think, Tom.
Alex, I don't know if you saw before you got on the Zoom, I asked the audience who in the audience was dying to use stablecoins. And in this robust audience of several hundred people, not one hand went up. So I wonder, what we're talking about here in terms of the practical application, but I guess we'll see.
Paolo.
Dying is a strong word, but I'm interested.
Interested? Okay, we've got one interested. All right.
Paolo, should large stablecoin arrangements backed by U.S. Treasuries be understood as a new form of financial market infrastructure?
Yeah. So thanks a lot for having me. And I think Alex ended building a soft bridge to what I think I'm going to conclude my remarks with. And again, as an Italian American, I need to bring some international flavor to my answer. And I want to complete the discussion of what stablecoin issuer invests in, or at least their holding company. Thank God they're investing in my soccer team. One stablecoin issuer holding company.
What about the baseball team in the World Baseball Classic?
I'm a fifth-year U.S. citizen. Baseball, I'm not comfortable with, so I'm not going to opine on baseball.
All right.
On soccer team, I'm glad that one of stablecoin issuer has 10% stake. Anyway, talking about stablecoin and market infrastructure, I think I would like to make 2 points, one international and one domestic. The international one touch on one piece of international soft law that was drafted and published in 2012. Those are called the Principle of Financial Market Infrastructure. They were developed by the IOSCO, the International Organization of Securities Commission, and the Bank of International Payment Committee for Payment and Market Infrastructure, after the Financial Stability Board said we need to have more clearing for derivatives. So we had this international principle that set very solid foundation on how we should look at risk that infrastructure plays, not just clearing, settlement, but also payment system. And in 2022, before the EU started its journey with MiCAR, and before even the US, we started to talk about a legislative framework for stablecoin, those international organizations drafted a 30, 40 pages document that expand and try to look at stablecoin arrangement through the lens of financial market infrastructure. And the answer is that if stablecoin arrangements are used as a means of payment or a store of value, then the principle that we have internationally can be applied and can be used as a mechanism to inform the action of domestic lawmaker. Why do I care about this? Because there is one section in the Genius Act that we do not tend to look too much, but it's important if we want to look at the global market that stablecoin try to sort of capture. And Section 18 of the Genius Act cares about cross-border stablecoin issuer, and more precisely, foreign stablecoin issuer that want to access the US market. And that provision gives the Secretary of the Treasury the power, the authority, to look at foreign regulatory framework about stablecoin and study them and eventually assess whether or not they can be deemed comparable to the US one. And if they're deemed comparable by the Secretary of the Treasury, then the foreign stablecoin issuer can register with the OCC and access the US market with a lot of interesting ring fencing requirements. It's a very interesting provision. But at least the Genius Act, compared to MiCAR, had this openness as a global payment system to the cross-border nature of this market. And so I think this principle, that why I talk about this principle and the role of financial market infrastructure, is because regulators in derivative space, security space, have been looking at these principle of financial market infrastructure to run this comparability assessment. And so I think looking at stablecoin as market infrastructure, I think is very important, not just through the banking lens. And then building on Alex's point, and FSOC. And yes, there is one title of Dodd-Frank that we tend not to look too often because it's been less controversial than others, and that's Title 8 of Dodd-Frank, that talk about systemically important financial market utilities and financial institutions that perform clearing, settlement, and payment system. This is a bit conceptual. We need to dive a bit more into whether or not, what's going to come out of the OCC approach. But Title 8 offer to stablecoin some of the answer to the question and concern that Alex mentioned. Why? Because first it's a unique title of Dodd-Frank and a unique designation space. Why? Because the 8, if I got it correctly, SIFMUs, they've not litigated in court the designation. And that's an interesting feature because all other designation sort of sparks a lot of controversies. And perhaps the reason is because the legislator drafted a title that have regulatory costs but regulatory benefit. And those regulatory benefit are a clear path to get access to Fed account and a clear path to access to discount window privileges. And I think that perhaps looking at stablecoin through market infrastructure might put regulators, lawmakers, and policymakers in general think about other mechanisms that we already have in place for critical player in the infrastructural space, clearing, settlement, and payment, as a possible answer to the question of stability that Alex mentioned about stablecoin.
Rich, I've got a question for you, but before I do that, Sarah Jane, at the end of this, when we get to the questions, would you give us some insights into what's going on in the payments world? And Tom Honig, if you have some views on the thoughts of this panel, if you'd like to come to the microphone before they do the questions, we'd love to hear your views. Tom is former vice chair of the FDIC and president of the Federal Reserve Bank of Kansas City. So I think we can get some enrichment here from those two. But Rich, I guess we've seen sort of a flip-flop in terms of the administration's views on technology, stablecoins, cryptocurrencies, and I guess it's probably fair to say they're being welcomed with open arms. And we've talked about all of the issues that could raise with respect to inculcating what and who they are and how they operate into the mainstream financial services markets. So there's the movement to create a permission structure for the issuance of stablecoins by national bank trust companies, increase the risk of the disintermediation from the traditional banking system. How should the regulators be reacting? And what are the long-term effects of this sort of movement without, I would suggest, enough critical thought about the long-term implications of doing this? I mean, Anchorage was the first digital asset bank chartered in 2021. The control of the currency awarded 5 conditional charters to crypto firms for national trust companies last year. There are something like 18 to 20 applications pending. I would argue that much like the non-bank banks, the insurance trust companies, and ILCs, this is a lot of dogs chasing cars, and I'm not sure they know what they're going to catch when they catch it, but we'll find out. Give us your view in terms of the impact on banks, disintermediation, and regulators.
I think the way you ended the last panel was spot on in terms of, are we going to dismantle or discard 125 years of banking regulation and everything we learned as we move into this new digital space? And one of the things that I think a lot of people forget is that the current bank regulatory system that was built over the last 100+ years was built in reaction to banking and economic crises. 1907, Panic of 1907 led to the 1913 Federal Reserve Act, creation of the Federal Reserve System. Great Depression leads to the creation of the FDIC, SEC, 56 Bank Holding Company Act. Then you had all of the S&L statutes, which I want to get to. And then finally you had the S&L crisis leads to FIRREA, Fiducia in 1991 with prompt corrective action. And then finally Dodd-Frank in 2010 in response to the Great Recession. So it's a lot of trial and error. It's a lot of learning. And unfortunately, it takes an economic crisis and a response to an economic crisis for the, I'll call it the regulatory architecture, the regulatory scaffolding to be put into place to deal with it. And so now we're just kind of flying into this. And what kind of pain are we going to have to experience before the right kind of architecture is put into place? I think there's the potential for meaningful disintermediation risk, especially for community banks. And one of the things that I spoke to Bob Ledig about, who I know is here, is that I think there are some parallels with stablecoins to the emergence of money market mutual funds in the 70s. And in Banking Act of 1933, we had Regulation Q. It regulated depository interest rates for banks. It lasted, most people don't realize this, it lasted for more than 45 years. But it helped restrain competition among banks in the deposit arena. But then in the 70s, just like today, it's kind of ironic, inflation emerges, higher oil prices, Mideast instability, and of course you get higher interest rates to combat it. And so what you saw in the 70s was classic disintermediation from especially community banks, savings and loans, into money market mutual funds. And this absolutely had a negative impact on the real economy. It inhibited residential lending. It inhibited small business loans, small commercial real estate loans. And so I think this is the kind of issue that community banks are looking at and saying, have we properly evaluated the disintermediation risk that could occur from depositors moving into stablecoins?
Rich, I think you're spot on. I don't think people remember that between 1981 and 1992, because of those factors, money market funds, disruptions in the markets, interest rates, and inflation, 3,000 banks and savings and loans failed. 3,000. Another several thousand were merged with healthier institutions. So that was a significant weeding out that was caused by a number of factors, which we now realize, looking backwards, we probably could have, manipulated a little bit better. JP?
Thank you. Paolo, how do we square the parallel developments of reorganization of market infrastructure through clearing reform with the emergence of stablecoin, which doesn't need traditional clearing or intermediary parties?
I think like what we are talking now here is like the development of two parallel regulatory and legislative, like one is regulatory, the other is legislative reform that hit on the same bottleneck in the plumbing system. And again, like the clearing mandate for Treasury and some repo, there was a response for the dash for cash and the constraint on balance sheet capacity of a lot of investment banks in absorbing either the intermediary or outright Treasury requests in the Treasury market. And so like the role of central clearing with netting and a more direct mechanism to match buying and selling position that was seen as a way to smoothen or unclog the plumbing that got stuck in the 2020 and 2023. The reform is still been pushed by the SEC, the implementation, so there's still time. And it's interesting because they're going to be interesting potential new entrant in the market, in a market that until today has been dominated by one primary player, FICC, but CME and ICE are trying to enter into this important infrastructure market. And the interesting relationship with stablecoin is that stablecoin, they are now outside the clearing mandate perimeter, and so right now they would access those markets through, with a client approach with, an existing broker dealer. And so, like the interesting feature there is that like, what's going to happen if, a stablecoin issuer might face big redemption calls, and the pressure is going to be pushed on the same broker dealer or clearing members, and so. But when the system was developed, it was not envisioned, or at least like it was not in the premises, the fact that now I think US, Circle and Tether are some of the largest treasury holder in the world. So that's one interesting feature. Another interesting feature connected to that is, and I think reforms in the market structure and clearing are occurring, or at least have been under discussion, is the fact that stablecoin and redemption is 24/7. While the existing clearing market is still have time constraint. And so the big aspect there is like what's going to happen if a big liquidity demand comes in. And so stablecoin need to liquidate fast those treasury portfolio that they have, and they're going to push them down through the broker dealers, and the clearing house is not open 24/7. So that's another interesting potential frictions between the SEC reform of mandate clearing for Treasury and some repo, and the Genius Act and the new legislative framework for stablecoin. And I think that one last point that connects again with the discussion about FSOC and access to 10B facilities or having mechanism to get fast liquidity, then perhaps we need to think a bit holistically about how the new market structure for Treasury fits these new entrants that when the reforms started to be rolled out were not fully envisioned as potentially the biggest holders of Treasury. There are like data out there that the major stablecoin issuer might hold in the years to come around $1 trillion in Treasury. So those are going to be big players that if they start to liquidate and put pressure on the plumbing, is the plumbing going to be able to absorb it, or do we need other mechanism, the Fed, for example, as a mechanism to absorb that big demand to turn Treasury into cash in case of big redemption requirements?
Well, one follow-on question. To what extent do you think there's a risk of a cascading circumstance? And then is the data available for someone to calculate that risk, a regulator or someone else to calculate what the risk of some systemic result is?
The risk of
like redemptions turning into
So the interesting aspect there is like for like the way the clearinghouse work, there is a lot of reliance on, clearing members of the big broker dealers to provide not just margin for the position that they open, but this so-called guarantee fund that it's used to fill some gaps if one, trade doesn't go through. So that pressure is there. Like the system is still to be fully rolled out. So there is, I think, time until the end of the year for the central clearing for Treasury to be finalized. So I don't have a clear sense of where the data might be. And OFR, for example, I've not seen yet a study going back to Alex's role at the OFR that tried to look into the relationship between what's going to look like as a Treasury market. Again, there are new entrants that might play a role. There are a lot of interoperability aspects that have to be built in place there. So it's a market that is developing, and the same thing is about the stablecoin market. And the stablecoin issue, if they stay like as big as they are, the pressure might be less than if the market is going to turn into the $1 trillion as some people estimate to be in the near future. So I think that's an area where like the SEC, the OCC, they need to keep an eye, because it's a market that, like, at least when it was like the clearing market developed, look a lot at this sort of intermediated model. And right now, Treasury, like stablecoin issuer, do not have an interest in becoming clearing members. The cost for them will be too high because they tend to have just one position and do not deal. And so they rely a lot on broker dealers for them to process their transaction.
Well, one other note, I think there's a data issue potentially too in calculating systemic risk from private credit, or even in trying to understand upcoming regulations on alternative assets and 401k plans, is to how to calculate a potential impact of a policy choice and something like that.
Yeah. I think we can talk later about for private credit, because the OFR just came 2 days ago about like an interesting analysis of, I don't know if it would calm a bit the the news, but like he sort of contextualized the size of private credit precisely having access to confidential information. It's great. Yeah.
Thank you, Tom.
Alex, if we're going to wipe out the last 130 years of development in the financial services area, we don't need trusted intermediaries. We can go back to private money. Why don't we end up with a digital gold-backed currency?
I think it's a great idea, but I want to stop for just a minute to quibble with Paul on who the biggest holder of treasuries is. It's clearly the Federal Reserve at $4.5 trillion, and what the Fed does is hold treasuries and issue currency and deposits against those treasuries, except for their $2 trillion mortgage mistake, but leave that aside. Basically, the same thing. And so I think one of the most interesting competitions internationally in Argentina and many places is that stable coins compete with $100 bills for the international informal monetary system. And I say that as a way of introducing the notion that the typical stable coin is not a different currency. It's just part of the dollar system. If you're stable with respect to dollars, of course, you're not really stable in value, because as the dollar is depreciated by money printing, the stable coin automatically depreciates along with it. And that does raise the question of, well, could you have a stable coin payable in gold? And I think you could. By historical interest, I'd like to quote the inscription on the 1928 U.S. currency gold certificate series, where the dollar bills said on them, quote, "This certifies there have been deposited in the Treasury of the United States of America $10 in gold coin payable to the bearer on demand." That's what money used to be. That was government money, but payable in gold to the bearer on demand. But clearly you could have private money payable in gold to the bearer on demand, or payable in gold to the bearer at maturity if it were a debt instrument. And that could be done, it seems to me, on a stable coin structure. The goal might be, let's say, first of all, you'd have to have 100% gold backing. Maybe the gold is in the Texas Bullion Depository, and it's 1 for 1. There you would have you would have reinvented, Tom, the Bank of Amsterdam 17th century structure. We've got the gold coins here in the bank and we're issuing currency against them. That really would be a different currency. So we could ask the audience, maybe, would you rather hold a dollar bill, which was 100% gold-backed stable coin, or would you rather hold a Federal Reserve note, which is a pure paper currency? And maybe there'd be interest in that. Seems to me it might be. Friedrich von Hayek, in his celebrated essay, Choice in Currency, suggested that it's okay to have governments issue paper currency, but they shouldn't get a monopoly. They should have to compete with other currencies. And what he really had in mind was a gold-backed currency. It's just as a final note, how would you compare a government gold commitment to a private stable coin promise of being essentially a warehouse receipt against gold stored in some reliable place? Well, the United States has defaulted on its gold promises before. Rich, just as you were thinking about the same history, we could think about it in terms of defaults on gold promises. 1861, when they ran out of gold in the Civil War.
Alex, I was going to say that 6 years after the currency that you read, the United States passed the Gold Reserve Act and made it a criminal offense to redeem gold.
You are so right, and that's my next point. Well, I'm saying 1933 because 33 was the
executive order.
Was the default on the gold bonds, and the executive order. 34 was the Gold Reserve Act, which took the Fed's gold away, among other things, and then the United States defaulted on its international gold commitment in 1971 by reneging on its commitment to internationally redeem dollars in gold. So maybe, a privately reliably designed gold currency would actually be an idea that could be tried. Thanks for the question, Tom.
Alex, your reference to the Bank of Amsterdam reminds me of the tulip scandal. Maybe that's what we're talking about here.
Yeah, Rich, do you think there's a regulatory mismatch between community regional banks and national bank trust companies, which will not be required to meet CRA obligations and Black FRB holding company affiliate oversight? And also, if you can comment on the whole topic of asymmetric regulation, which was a topic in Tom's book, but also a major topic this morning.
Again, I think the Tom's point in the book about asymmetric regulatory risk is extremely important. Before I get to how national bank trust companies are different than banks, I mean, what we've learned over the last 125 years, but we probably have learned it over an even longer period of time, is that bad actors, bad borrowers, scam artists migrate to whatever regulatory system has the least amount of regulation. And we've seen this time and again. We saw it during the savings and loan era. But I mean, look at a national bank trust company. I know for my bank, serving our community is an essential element of what we do, and CRA compliance, which is something that these institutions are not going to have to do. And it takes a lot of time. Federal Reserve Board oversight, not only of the holding company, but of the affiliates. Another big issue, the separation of banking from commerce, which has been a longstanding principle, also would be gone. I was thinking about prompt corrective action. Would these national bank trust companies be subject to the limitations of prompt corrective action? I don't think so. Minimum capital and minimum reserve requirements, privacy rules. There's just so many. It's such a lower level of regulatory oversight, and you just wonder how much risk is going to migrate to these institutions because of it. And of course, it then in the community bank world, we like to complain about credit unions because they're not subject to CRA, but here again, we're not, another financial institution not subject to CRA that we have to compete against. So I think it's a big issue.
Paolo, I want to come back to the reference you made to private credit for several reasons. Number one is that I've been an investor in private credit deals. And from the investor point of view, we talked about this last night at the speakers dinner, it's really about the mark, right? So the argument in the press essentially boils down to there's no public scrutiny and no regulator looking over the mark of these loans. And you can argue about what these loans are. I mean, I guess some would argue that these are the junk bonds of the Milken era in the 1980s, right? Just back in a different form. But they're also could be categorized as the lesser quality loans the banks didn't want. For however you characterize it, the question is the mark. And I was able to get out of my investments with the mark intact, so I'm a happy camper, right? I mean, before anything got written down, I redeemed my interests. And the press is obviously fueling this whole area. And the one thing I have learned is that there is an enormous impact on financial services values, runs, and panics from psychology, right? It's the psychology of the human being. And what we don't know is the same chemical in our brains that forces us to run to investments where we see everybody, all our neighbors making money, is the same chemical that forces us to run from them when we see problems. So it's the same thing in reverse. So, a lot of this is perceptual, a lot of it is newsprint. What do you see as the underlying fundamentals of the private credit market and where it's going?
Yeah, that's a great question. I'm teaching financial institution this semester. So with students, we just realized that every day there are at least 2 or 3 articles on the Wall Street Journal, Financial Times about private credit and different take on private credit. And Matt Levine, less frequently than I thought, have been blogging on private credit. And in the last podcast, he had a very mild position on the risk there. So just to, I think a few points that I think I want to build on what you said. I think on the marking aspect, the evaluation problem, I think this is very interesting. I think recently both Senator Warren and Secretary Bassett took a similar position in, for example, slowing down the rolling out of access to private credit and private market for retirement account. And that ties a bit together to what you mentioned. It's there's a big discussion about the gating system. If you invest in a closed fund, you know that the money is there for the long run. If you want to redeem first you might face restrictions or you might have to pay fees. And the problem is that that's where sometimes the passing down of that mechanism to the retail investors is very difficult. Why? Because you might, as a retail investors, you might be driven by the short-term needs or react by what your neighbors, as you said, might do, or what you read. If you see 4 articles on the Wall Street Journals about, oh my God, what's going to happen, you want out as fast as possible. But on the other hand, this fund were not created or developed for that reason. They were precisely trying to fill a gap post-2008 and post-2008 reform for those market where traditional banks, they found not comfortable or didn't have the balance sheet capacity to lend to. So I think that's one important aspect, which is precisely private credit is critically important for middle market. And at the same time, that the way you invest in those kind of funds is different than for a money market mutual fund. But I think the perception that some investors might have is that it's the same thing. And the problem is that they're not banked, but they can be runnable. They might be subject to massive demand to withdraw, as happened in the past few weeks. It started with I think Blackstone with 6 or 7%, and other fund that started to sort of build up. As soon as the news that investors start to withdraw from a specific fund, then it sort of spread into the system. So I think one point is let's enforce the law privately. It's there are gates, we are just comply and we restrict redemption to what it's in the prospectus. So I think that one interesting aspect that might tie to the behavioral aspect those instruments were not created to be runnable, but if you build soft approach and you allow exit too easily, then you become runnable, and then panic start to hit the system. Another one is the valuation aspect that you mentioned. Is there is a big difference between the economic value and what it's in the books. And some funds are trying to address that with external evaluators. I think Apollo came out a couple of weeks ago saying that precisely to address this issue and to provide more transparency and more, and stabilize a bit their investor base, they relied on external evaluator to provide a mark of their books. And so I think that is another important aspect, bringing a bit more transparency, and so that investors feel more comfortable about what is in the fund they invest in. And I think the other one is, thinking about there's a lot of discussion, are they systemically important? Is this systemic risk? So I'm not going to point too much on that. The data that the OFR published 2 days ago, a report, and one interesting focus on that report is that I think the size is less big than expected, and so I think in terms of size should not build such a big concern, should be such a big concern. But what is interesting, I think, is the interconnectedness point, the linkages, and precisely I think there are two aspects that the report focus on. On one side is the call element that some funds might have, that they might ask the existing investor to chip in if the fund is facing sudden withdrawal. So I think this is an interesting aspect that we faced also in 2008 with some university endowment face that big pressure, but be bind contractually to recapitalize or invest again in the fund. And the other one is the connection between banking sectors and the private credit. And that's an interesting link that, it's kind of interesting. Yesterday on the news, or 2 days ago, I saw that there were news about large GSIB still committing into line of credit to private fund despite the current condition. So they know how to price risk. They know how to price this, line of credit for private credit. But I think that's an area where regulators should keep an eye open because, again, what we need to be careful, I think the size right now is not the biggest concern. I think the concern might be the linkages and how those linkages might become weaker. And so that's my take. But it's fascinating to teach now financial regulation because there are so many hot topics that touch on the basic framework of how the financial ecosystem operates. So
yeah, the linkage is interesting because in some respects the banks get pulled into the private credit market the same way that they were pulled into the subprime market in 2007, right? Because they finance the people who finance those loans. So I guess we should go to questions, and if we have a little time, we'll go back to the panel. But Tom,
and it's a race, Tom. It's a race to the bottom,
right?
When they get pulled in,
right? Exactly. So Tom Honig, he was vice chair of the Fed, president of the Federal Reserve of Kansas City. I'd love to hear your views on these topics. And then Sarah Jane, we're going to come back to you. Where's Sarah Jane? Here she is. Okay. All right, we'll come back to you in a minute when you get to the mic.
Okay. First of all, thank you, Tom. I do have some comments. I would start by saying that I very seldom disagree with Alex, and this is no exception. I'll talk about stable coins. But I will start by saying that my experience, maybe others, is that one of the most pro-cyclical forces that we have is regulation. When things are tough, that's when the regulations get tough. When things are easy, and we're experiencing that now. We're opening up the market. It's wonderful. Everything's going to be wonderful in the future. And stable coins is an example. As someone said, stable coins is basically a mutual fund with a payments component, which is very important to this. And so what you want to do with that is you want to get scale, and the first thing you want to do is get legitimacy. That's the Genius Act to start with. And once you have the Genius Act, you build forward from that with that stamp of approval. And the next thing you have is you work very hard to get access to a master account at the Fed so that you can clear. Now you're becoming more like a bank, and therefore you can draw deposits. I mean, you can draw something to you called a stable coin and build on that, and that'll come next. And then once you have that and you're backed by by treasury securities or bank deposits for a small margin, the difference between your costs, you want to build that margin, and so you want to look for other high quality assets to back your stable coin, and that could be a AAA whatever that someone rates for you. And so that helps you build more scale. And then once you get to that point, you get more international, what you want. And then you become systemic. And that's the bullseye. Because now you're going to get bailed out when the next crisis comes. Ask the mutual fund industry who got bailed out. Right. So that's what I predict. And then we'll have the other side of what I'll call the pro-cyclical force. When that happens, we'll begin to regulate them to death, and we'll start over. So my view is try it, but no bailouts, no access to the safety net. It wouldn't last near as long as what we're going to let it with the Genius Act and access to the payment system and the safety net. So, Alex, you're right.
Well, Tom, I have never disagreed with you or Alex, and today's no exception.
Thank you.
Sarah Jane, you had a comment.
And Tom,
go ahead, Alex.
I was going to say, Tom, great to see you, and I also have trouble disagreeing with you.
All right. Sarah Jane has a comment.
So this is not nearly as enlightening, but I will say that for those of you who represent banks that have been involved in payments fraud, besides the federal interest in payments fraud that you've all been reading about, the Uniform Law Commission and the American Law Institute are launching soon a project to talk about how to alter some rules in order to reduce the risks, especially to smaller banks. And so it'll be very interesting to watch. They have a wonderfully open process at the Uniform Law Commission, which is, if you're interested, you sign up and they send you all the materials. And this time, a lot of the meetings will be on Zoom. So you won't necessarily have to leave your office in order to participate in the meeting. And the people in this room are exactly the kind of people that the Uniform Law Commission and the ALI depend on to bring information to them. And in a sense, it qualifies almost as negotiated rulemaking.
Thank you, Sarah Jane. And now we've got some questions for our panel.
Hi, I have a question about something I haven't been hearing as much about in this panel that I expected to be hearing about, which is the differential BSA AML requirements around banks and all of the payments that banks do, big banks, small banks, all banks, and stablecoin transactions, right? And I think one of the reasons why no one raised their hand on stablecoin is because dollars work great for us, right, in terms of the people who are in this room, and banks work great for us in general. But the cost of the BSA AML, like layers of blankets of overlapping and insane, and when you were talking earlier on the panel on like supervisors and so forth, if you think safety and soundness is undefined, like, oh boy, BSA AML makes that look well-defined. And so that has metastasized into an enormous cost at banks that stable coins don't seem to have to pay, right? And we see this, a close friend of mine, a relation, just started a new business, but he has to make payments in he lives here in the United States, he has to make payments to people in Kenya and in Serbia and in other countries in Eastern Europe and in Africa. And banks are really not that interested in a new business that has to make payments overseas regularly. But I think the reason for that is 100% BSA AML. And those payments wouldn't be regular. It's like, oh, we had to hold this payment up for 2 weeks while we investigated it. You know, that's not good for your supplier in Kenya. I'm just like, why is there any even reason for stablecoin? Why can't we unconflict regular dollar payments?
So the BSA AML issue is one I think we were going to get to in the tokenized deposit section, I hope. But let's ask maybe Rich and Paolo to speak, or at least Rich, to speak to that issue a little bit. And if not, I know Bob Littig can add his 2 cents. You don't want to? Okay, he's deferring. Rich?
I would love to hear Bob's, but I agree. I mean, the BSA AML requirements that, especially in the smaller banks, are very intense. And I could see why these institutions were reluctant to work with your relative. And again, I think this is just one more, I'll call it structural inequity with National Trust banks, because it's not clear whether they'll be subject to the BSA AML requirements.
Paolo?
So the premise that ML, that's not my area of expertise, but in cross-border relations, like an area that I'm very familiar with is derivatives market and the use of mechanism to build bridges with foreign jurisdiction. So the European Union, not the United States, the European Union has been using this authority that it has to allow foreign clearing houses or market participants to access European infrastructure on the base of an equivalence if the foreign jurisdiction comply with basic anti-money laundering, know your customer requirements, so on and so forth. The European Union has been very active in enforcing that condition to then allow a foreign jurisdiction to access EU market. And for example, rescinded this recognition for South Africa and some of the Emirate states. Why? Because they didn't comply with anti-money laundering regime that were equivalent to the European one. So the EU has been able to lift other countries' AML regime by threatening them to stop access for our other market services. Again, this is the academic speaking, and I have no idea. That's an area where financial diplomacy might be able to soften the distinction and the different regime for AML, but at the same time, that's just the regulatory framework. Then you have to build a business case for banks to engage in cross-border payment for small, medium amount. That's where I think the fee and the revenue generation is very small, so why would I engage in an area where there is risk associated with that? But there are, at least thinking about the regulatory framework, there might be aspect of foreign diplomacy that can be deployed to convince, induce, force foreign jurisdiction to beef up their anti-money laundering. And that's what the European Union has been doing with some jurisdiction, and they use precisely this very powerful tool of threatening them, or actually in some cases rescinding access for financial institutions in South Africa, for example, to access the European market. So it's very powerful.
I think we have to go back to January 2009 when Bitcoin was introduced. And if you read the 9-page Bitcoin paper by Satoshi Nakamoto, whoever he may be, and we've had lots of theories about that, but if you read that, why was Bitcoin created? It was created to avoid government intervention, government overview, and big banks. That's why it was created. So we shouldn't be surprised that it's a workaround with respect to AML and BSA. The question in my mind is how the regulatory structure catches up with it. Because let's go back to stablecoins. 80% of stablecoins today are used to clear cryptocurrency transactions. Why? Because cryptocurrency transactions are unstable values. And so could be $10,000 more in the afternoon than it is in the morning. So you use a stable coin to clear the transaction. But the highest and best use of cryptocurrency still is to finance global crime. I mean, there's just no doubt about that. Maybe that will change, but nobody takes a Bitcoin and goes to the grocery store to buy bread. It's just not happening. And so what is shocking and just unbelievable to me is that we're sort of embracing financial and the most heinous parts of crime around the world by embracing these new technologies without having proper regulatory insights and control. So is BSA and AML applicable? Absolutely. Does anybody think it's going to be applicable? I don't. I mean, I think the whole thing was built as a workaround. And so the question I would raise is, can the regulators keep up? Do they have the technology? Or is it just a possibility? Go ahead, Alex.
We have the implementing regulations for the Genius Act due in a few months by all the banking and it's the banking regulators who've been assigned to issue the regulations. They are very familiar with these issues. Very interesting to see what comes out of that.
Yeah, the question I think is also, do they have the resources for the technological skills that they're going to need? And I don't know if they're going to have the resources. That's the problem. They can always if they have the money, they can create the resources and the knowledge base, but I don't know that they're going to have the resources. Other questions? Yes.
Joel McGill, former software engineer with Coinbase. You kind of mentioned the initial premise of Bitcoin, and yes, it was like initially created for a workaround, but like since that creation, like the primary use case of it has changed. And so now, today, it's more so a store of value, and if you look, historically at it every 4 years, it is actually a hedge against inflation, because anytime you go back 4 years, it's always up. Sure, it may, jump by $10,000 in a single day or even more. But at the same time, 4-year cycle after 4-year cycle, it keeps its value. And so, and also there's a set amount of it. So in the sense of it is closer to a commodity like gold, it's actually definable like how much of it there is going to be. So the supply and demand is a little bit more structured. Also to the point of the gentleman who mentioned like having a stable coin that's closer to, like that's backed by gold, they have that today, which is like Tether Gold or Pax Gold. And you can essentially keep those and redeem them for physical delivery or, for US dollars. And so like, I guess my question is, the gentleman mentioned that like regulation has been somewhat reactive to crises. And so I guess if that's been the case over the past 100 years, I guess my question is like, why is it not more proactive in terms of being more forward thinking in terms of technologies which are, coming down the pike, and how to pivot and plan for that so that, the U.S. is not behind other countries?
Right. I guess if you guys want to answer this, that's great. I just want to say two things. One, you raise an interesting point, because what I think people don't do enough is distinguish between, for example, Bitcoin as a security or a commodity, and Bitcoin as a payment instrument. Those are two diametrically different things. I mean, I'm all for people investing in speculative and, aspirational securities like a Bitcoin. That's terrific. I wouldn't put my whole net worth there, but if you want to do that. But when it comes to a payment mechanism, it's a whole different set of issues. And I think that's where I think the workaround issue becomes a lot more prominent. But Alex or Rich or Paolo, do you have any comments?
Quick one. We can have, I spent half of the semester on financial regulation talking about approaches to regulating market phenomena and so on and so forth. And I think the quick answer is what Tom mentioned, the aspect of procyclicality. It's like there are very few incentives if the market is doing well to slow down. We have the experience in the Basel post-financial crisis approach of counter-cyclical capital buffer. Again, and doesn't even require legislative intervention, simply a regulatory action. Very few jurisdictions, like Singapore is one of those, that trigger that counter-cyclical tool. Why? Because the political, we can talk about interest group or political economy, do not create the incentive to slow down if things are going well. And so this goes back to the procyclicality problem that we have, and the lack of incentive of building procyclical tools to slow down building up of risk, or like try to think about how can technology can how can we create ex ante regulatory framework for technology? Why? Because the counter argument that you get, even if you proactively ex ante try to create a clarity on technology approach, people might say you are preventing technology to bloom to the level that they want. So I think that's a bit like the interest group story of like why rarely we have proactive regulation or legislation, because the incentives rarely are aligned.
Alex?
Tom, could I say this question of the cyclicality, the pro-cyclicality of many things? A lot of things are pro-cyclical. That's why we have cycles. And the busts are created by the booms. And there's a lot of classic financial behavior and wisdom, and it all applies to cryptocurrencies or stable coins or Bitcoin, just like it applies to every other phenomenon. I wanted to mention one of the greatest of classic sayings, which is, nothing is so disturbing to your psychological equilibrium as to see your neighbor get rich. And my response to that has been, that's not quite true. There's one thing that's more disturbing to your psychological equilibrium, and it's to see your brother-in-law get rich and to hear about it from your wife. And so we're going to have these cycles, and the cycles create prices. And what is a price, and how much can a price change? And when we convince ourselves that prices always go up of something, whether it's every 4 years or every day or so on, that is classically setting up the boom that sets up the bust. And there I'll close just on one last saying, which is the greater the flow of credit into a class of things, the more upward pressure on the price of that thing. The more the price rises, the more it attracts credit and leverage until it all goes into reverse. And then the prices go down. And here's the classic saying, how much can the price of any asset, including every crypto asset, as well as houses, as private credit, as land, as office buildings, as anything you want to think of, how much can the price of an asset go down? And the answer is more than you think.